Imagine this. You're sitting at your desk, charts on the screen, a cup of coffee next to you. The market just opened. Prices are moving fast. Your heart's racing. You see one stock breaking out, another's crashing. You want to jump in, but your hands freeze. Is this the right time? What if I'm wrong? What if I miss it? Welcome to the world of momentum trading. Fast-paced, high stakes, but built on precision. And that's where this book, Momentum Masters, comes in. It's not just a trading manual. It's a conversation between four masters of the game: Mark Minervini, David Ryan, Dan Zanger, Mark Ritchie II. Each has carved out their own legendary path in the market. This book is like sitting down in a room with them, asking the big questions, and getting brutally honest answers. So, let's sit in on that conversation. The core question: what is momentum trading? Minervini keeps it simple. You want to buy high and sell higher. Sounds basic, right? But it flips the typical advice on its head. Most people are told, buy low, sell high. But momentum traders, they're looking for strength. They want stocks that are already moving up, not falling knives. Think of it like this. Would you rather invest in a horse standing still or one already in full sprint? Momentum is about riding that sprint, but doing it with rules, discipline, and risk control. Let's break it down into three pillars, because all four traders agree on these. 1. Mindset over method. Most people are looking for the perfect indicator, the perfect setup, the one magic formula. But Minervini makes it clear, success starts in your head. If your psychology isn't right, if you panic during losses, chase during wins, or trade out of boredom, nothing will save you. And David Ryan agrees. He says his biggest breakthrough came when he learned to control emotions, not just strategies. So ask yourself, can you sit in cash when there's nothing to trade? Can you take a loss without revenge trading? Can you follow a plan even when it hurts? If not, mindset's your first trade to fix. 2. Risk management is king. Dan Zanger, who once turned $10,000 into over $18 million, says it best: cut your losers fast, real fast. All four traders repeat this in different ways. You never risk big on one trade. You never hold and hope. You never argue with the market. Minervini sets hard stop losses, usually within 5 to 8%. If a trade hits that point, he's out. No questions. Why? Because survival is priority number one. You can't win if you're out of chips. 3. Pattern recognition and timing. Momentum trading isn't about random guesses. These traders look for specific patterns: breakouts from bases, tight consolidations, volume spikes, relative strength. Minervini, in particular, looks for what he calls volatility contraction patterns, VCP, spots where a stock tightens its price range like a coil before exploding upward. It's not enough to buy a strong stock. You need to enter at the right time, with the right setup, and a clear exit if you're wrong. Minervini doesn't buy breakouts just anywhere. He waits for stocks with strong fundamentals, forming technical bases, and then exploding with volume. Picture this. Stock is uptrending. It pulls back and forms a sideways base. The price range starts to tighten. Volume drops, showing no panic. Suddenly, a volume surge pushes it through resistance. That's the green light. Entry point, just as the breakout starts, or during a cheat entry slightly before, when it starts poking above resistance on lower volume. Stop loss, right below the base, usually 5 to 7%. Position size, never more than what he can lose comfortably. Risk per trade is always defined: how they handle losing streaks, This part might surprise you. Even with decades of success, they still lose. A lot. Zanger says sometimes he has 10 to 15 losers in a row. Minervini says he's wrong nearly 40% of the time. But here's the key. They lose small and win big. Minervini explains, if I lose 5% on 5 trades, but make 20% on one, I'm still ahead. So the game isn't about being right every time. It's about staying in the game until you hit a home run. And when they're in a slump, they reduce size, trade less. Go back to basics. Track every trade like a scientist. No ego, no emotion, just process. Picture this. It's Sunday night. The market opens tomorrow. You're not watching Netflix. You're not scrolling Twitter. You're preparing, because this is where real traders separate from the rest. This is what the momentum masters do, week in, week out. Let's start with Minervini. He doesn't just wake up and see what's moving. He runs a routine every single day. Here's what that looks like. Step 1, build a watch list. He scans thousands of stocks, but he's not looking randomly. He filters. Stocks hitting new 52-week highs. High earnings growth, relative strength versus the market, tight consolidations or VCP setups, low supply, meaning fewer sellers, accumulation by institutions, volume clues. By the time he's done, he has a short list of setups, his A list. This list is everything. It's like a sniper narrowing down a target. No guessing, just scanning for strength. And not surprisingly, David, Ryan, Zanger, and Ritchie all follow some version of this. Let's understand VCP, Minervini's signature setup now. The volatility contraction pattern, VCP, is Mark Minervini's bread and butter. It's not magic, it's not a gimmick, it's just clean technical logic. Here's how it works. Stage 1, the stock runs up, then forms a base, a sideways pause. Stage 2, inside that base, the price swings start getting smaller. Volatility contracts. Stage 3, volume drops, telling us sellers are drying up. Stage 4, suddenly a breakout on big volume. The stock launches. It's like a coil being wound tighter and tighter, and then released. Why does this work? Because it shows supply and demand dynamics. Sellers are gone, buyers are ready, the breakout has fuel, and when that happens, boom. The stock can run 20%, 50%, even 100% in a few weeks. All 4 traders agree you don't just jump on any breakout. You wait for the right structure. Minervini sometimes uses a cheat entry, getting in just before the breakout, when the pattern shows a low-risk point. Zanger prefers entering right as volume surges through resistance. Ryan watches the market context. Is the general market healthy? Is there confirmation? The rule is, don't chase, don't guess, don't jump late. Instead, define your exact entry zone. Place a stop below recent support. Risk no more than 0.5 to 1% of your total capital per trade. Let the trade work, or get out fast. Minervini teaches a concept called pyramiding. Let's say he buys 100 shares on the breakout. If the stock moves up and acts well, he might buy 100 more, at higher prices. Crazy? Not really, because he's adding only when he's right. He never averages down. That's for gamblers. Zanger does the same. He scales in as the trade proves itself. But the key is tight risk control. He never lets a trade run wild without stops. Let's look at a typical trading day from these masters. Pre-market 6:30 a.m. to 9:30 a.m. Review market news but don't react emotionally. Finalize the A-list of potential trades. Set alerts and limit orders. Prepare mentally. Visualize trades, review setups. Market hours, 9:30 a.m., 4 p.m. Monitor watch lists, but don't overtrade. Only act on pre-planned setups. Review volume and price action live. Avoid distractions. No social media noise post-market after close. Review all trades, what worked, what didn't. Log entries, exits, mistakes. Screenshot charts. Adjust watch list. Study, read, journal, analyze. This isn't casual, it's a system. Like an athlete training for competition. Even the masters go through rough patches. What makes them different is how they handle them. Minervini's rule: when in doubt, get out. If the market isn't giving clean setups, he stays in cash. He doesn't trade just to make something happen. David Ryan has another trick. Cut your size when your confidence is low. If he's in a slump, he trades smaller, 25% or 50% of his usual size. That reduces emotional damage. Zanger might stop trading entirely. Go hiking, clear his head, return with focus. Bottom line, they protect capital and confidence. They know the next great trade is coming, but only if they're still in the game. What beginners get wrong. Let's address this because all four talk about it. Here's what they see most traders doing wrong. Chasing hype. Overtrading low-quality setups. Ignoring risk. Lacking a process. Getting emotional. Trying to be right instead of profitable. Minervini says, the market is not your friend. It doesn't care how smart you are. You can't wing it. You need structure. So here's a checklist. The Momentum Master Starter Pack. 1. Use a stock screener to filter for high-growth, high-RS stocks. 2. Learn chart patterns, especially VCP, breakouts, bases. 3. Write trading rules and stick to them. 4. Keep a trading journal. Track everything. 5. Study your losers more than your winners. 6. Treat trading like a business, not a hobby. You've got the strategies. You've built your watch list. You even know when to enter and when to exit. But let's be honest, that's not what most traders struggle with. What derails traders is everything that happens between the trades. The waiting, the overthinking, the fear, the boredom, the temptation to break your own rules. That's the invisible game. And this final part is about that. Let's go. Battling FOMO and impatience equals Zanger calls this the trader's disease. You watch a stock run without you, and it eats at you. I knew I should have bought it, so you chase the next one. You skip your checklist. You force a trade, and it goes against you. Minervini says the fix isn't mental strength, it's structure. Set hard rules. No A+ setup equals no trade. Reward yourself only for following the process, not for making money. Treat each missed trade as a lesson in discipline, not a mistake. When you really get this, your self-worth stops depending on market moves. Sometimes the market just punishes you. You lose 2-3 trades in a row. Now you're emotional, frustrated. You start trading for revenge. That's called tilt, and it destroys accounts. Ritchie says he used to fight the market when things weren't working. But now, when I'm not in sync, I shrink size or stop trading entirely. This is how pros deal with slumps. Cut position size by 50 to 75%. Switch to simulation for a few days. Study past winners for pattern memory. Don't try to make back losses. The goal isn't to win every day. It's to protect your edge and your mindset over months and years. Behind every big win, a decision. Let's go behind the scenes of a few breakout moments from the book. David Ryan, Quiet Confidence. He was watching a growth stock consolidate on low volume. The pattern wasn't textbook perfect, but he noticed something subtle. The stock refused to break down, even on market weakness. He built a position slowly over 3 days. The stock exploded, giving him a 40% win in 2 weeks. The takeaway? Sometimes the market whispers before it screams. Mark Ritchie II, the exit that made the trade. He took a clean breakout trade, but halfway in, the market reversed sharply. Instead of holding and hoping, he exited instantly. The stock gapped down the next day. It wasn't a huge win, but it was a huge save. He says that discipline created more wealth long-term than any single home run. Most people think trading is about hitting a daily or monthly profit goal. But the masters? They treat it like a career, not a hustle. Here's what they do differently. Cash flow comes second. Process and risk control come first. They don't chase lifestyle upgrades with every good month. They invest outside trading, real estate, businesses, funds. They keep a low burn rate, so they never feel forced to trade. Zanger says, you can't focus on making good trades if you're worried about rent. Trading should give you freedom, not trap you into stress. Life beyond the chart. A surprising truth: the deeper you go into trading mastery, the more you realize it's about your relationship with uncertainty. Can you be wrong and not take it personally? Can you do everything right and still lose without blaming? Can you delay gratification for months for one trade? Ritchie says, trading is just a mirror. It reflects back who you are. That's why most people fail. They come to trading looking for money, but what they need is maturity. The best traders don't just master setups, they master themselves. Here's what each master said they wish they had done sooner. Minervini said, I would have focused on one setup and gone deep instead of chasing everything. Ryan said, I would have taken fewer trades and tracked them better. Ritchie said, I'd spend more time journaling emotions, not just entries and exits. Zanger said, I'd avoid leverage in the beginning. It kills more traders than anything else. You don't need more strategies, you need more self-awareness and fewer distractions. Final checklist. Becoming a master. Here's a distilled final roadmap from all 4 traders. 1. Pick one setup and study it obsessively. 2. Build a written routine for pre-market, intraday, and post-market. 3. Track your mental state, not just your trades. 4. Sit in cash when there's no edge. 5. Take breaks after slumps, not revenge trades. 6. Think in years, not days. 7. Live simply so trading is never about pressure. 8. Study your own behavior more than you study charts. Remember, you're not here to just trade. You're here to build a career, to grow into someone with elite emotional control, long-term clarity, and financial independence. The charts won't do that for you. The market won't hand it to you. But if you treat this as a craft, if you show up with humility, structure, and hunger, you'll become one of the few who don't just survive trading, but thrive in it. And if this audio summary helped you grow, hit that like button, subscribe, and share this with someone who's on the same journey. Drop a comment below. I'm not just trading, I'm mastering.